What's up, mortgage coach community? Super pumped to interview this guy. He is always one of the hardest folks for me to pin down and get into the mortgage coach community, but he's also always the smartest, one of the most valuable people for loan officers that want to elevate their career and just be super intentional and smart about your business. So, Julian Hebron, what's up, buddy?
Hey man, how are you? Thank you. Too kind.
Well, you are such a man of details, mortgage coach community. Every time I talk to Julian, I tell you, hey, make sure you read his blog, The Basis Point. But guys, he is on fire on Twitter right now. I said this, I think it was about 2 years ago. You were at, I think it was a digital mortgage conference, and you were just like the headlines. It was like
Going
one
off. Yeah.
like I did not use Twitter before that. I mean, I had a Twitter account and
I
every once in a
remember
while check it
that.
out. But I'm like,
Yeah.
okay, this is a reason to use Twitter. And then I use it for lacrosse and some sports stuff. But for the most part, I use Twitter to follow you, dude.
Well, thank you for that. It's funny because I've cooled for now. I go back and forth, but I'm cooler. I'm definitely cooler on LinkedIn and Facebook. For some reason, they haven't been like speaking to me lately. I still love LinkedIn. I think LinkedIn's strong for me, but Twitter is the one. It's this idea. Yeah, I kind of honed this over time of being able to just do a topic fast. Like even LinkedIn doesn't have like threading. And to me, the threading is what helps to kind of go faster. And it's why I've kind of migrated a little bit to that. I'll get back to some longer form blogging stuff very shortly here. But for now, with being very busy and then Twitter getting more sophisticated about threading, it's you can do you can do the quick hits, but I mean, even with the digital conferences the way they are now, anything I watch or do, I can sort of live document with charts the whole thing. So it's turned into my thing. So anyone that wants to follow me, it's just the basis point on Twitter, and pretty active every day.
Yeah. So check it out. And for any new loan officers who are like, who's this Julian Hebron dude? And why should I keep watching this? He used to be a mega producer for Wells back in the day. He was the chief marketing officer for Lend US / RPM. He was a marketing executive for Loan Depot. And he was a judge 2 years at the Digital Mortgage Conference. So, some of the best tech companies are coming into the Shark Tank. And Julian was like that, that judge that was giving him a score. Julian, why don't you just give people a real high level kind of overview of the basis point and what your current mission is? And then let's get into the topic at hand.
Yeah, sure. Thanks. The basis point is a sales and consultancy for banking, housing, fintech, right? That's is the simplest way I could put it. And because I have been deep in the weeds, both in the mortgage space from a production standpoint, but before that, I was in the money management business, and I've been in these deep roles in both sales and marketing, in banking and financial services my whole career. And so 2.5 years ago, I had been doing the basis point behind the scenes as a long time, both as a producer and a production manager, for the same reason all of your community does it. I was kind of one of the early ones on like the web, and all the social is the marketing machine for the core loan production business. So that's what the basis point was for many years. It started leading to much deeper stuff. One of the breakthroughs was Zillow wanting to hire the basis point as they were building out their mortgage strategy. And then some of the consulting works was like moonlighting, and then it really evolved into a thing where I'm like, all right, it's time to cut the cord from being, a good producer, good corporate soldier, and build out this business to serve the, lending, banking, fintech community.
And I'm going to put it my way. So there's a lot of people that can create content for B2B. There's not a lot of people that can take that insider content and make it consumer friendly. And even make mortgages cool. Like there's an edge, there's a funness to it. And one time I was talking to a Zillow executive, and she said that literally the consumer direct content you write, he is the best on the web. So guys, really unique personality that knows the insider speak, and he's also studies consumer trends. So what I want to do right now is I want to help you, you're a loan officer, or you're on this call and you lead loan officers, to identify what are the hottest opportunities in the market. And we're going to focus on three. And and Julian is going to bring some data. He's going to bring some insights, and then I'm going to connect that to you as a mortgage coach. How can you be really smart about the biggest opportunities in the market today? So Julian, let's rip.
All right, yeah. So if it's cool, I was going to share a couple slides and just go through these three topics. So if that works for you, as you know, I don't try to just talk off the top of my head. I like to kind of have some visual aids. So, as Dave said, here's kind of the three topics that I was going to zip through. So let's start with this pivot to purchase, and I'm just going to kind of like cut right to the chase on this part. Because here's the numbers in terms of actual new and existing home sales. This is total home sales for last year, this year, next year, right? So I'll point out a couple of notables, like, because this is kind of, it's clean, but it's still throwing a bunch of data right out of the gate. But the good news is home sales in aggregate are going to grow this year to just about 7.25 million, right? And we know that always about 85% ish are existing and the rest are new. And these are the breakouts according to all the projections for now, right? So you've got 7 million purchases to go around this year and next year, which is growth from the previous year. So you're like, great, we've got a bunch of purchases to do, okay? But it's not maybe as big as you might think, because when you peel into the units, like the actual units that are going to happen. So look on the 2020 bar for a second, the dark part of the bar, the purchase part of the bar on 2020, where it says 4.87 million. That's 4.87 million units, total purchase loans that were done last year. If we come over to the 21 block, you can see not only do we go from about 40 to about 60% of the market being purchased, but about a little over 5 million are units. So that's what we've got. That's what everybody has to capture. And so I know everyone has their ground game. So I'm speaking in aggregate. I'm going to do one more aggregate that I think is interesting, and then we can kind of drill in, Dave. But go ahead. Sorry.
We'll go back to that slide.
Sure, yeah.
One of the things I love about you too is you make numbers cool. And every time I see you visualize data and stats, I don't know. Maybe it's just my subjective opinion. I think you do it better than anybody. I like it.
Thank you.
And so sometimes you put those as things that people can grab off of Twitter. Is that right? Like if people saw this, I mean, obviously guys, you could take a screenshot of this, integrate it into a realtor thing, but be cool. Like go follow Julian on Facebook, or excuse me, not Facebook, LinkedIn and Twitter, follow the basis points. And that's one of my things. I think his data is unique. It's consumer friendly.
Exactly.
Screenshot it, build it into your presentations.
And for what it's worth, yeah. So here we are. We're all business people talking to each other, but that's the secret sauce. I mean, I was in the retail trenches, both on the money management business and the mortgage business forever. So that's the whole point: is how do you do what you guys do today? Like you're dealing with consumers all day long. This is a little wonky for consumers, but it's definitely tangible for realtors and all your partners that you work with, right? So that's the kind of stuff that you can so on the purchase game, I was always a purchase DNA guy as a producer. Like to me, there's purchase DNA people and refi DNA people, right? And I used to look at refi colleagues and folks that were on my team, and I was just like, damn, I get purchases. As a producer, I obviously run plenty of refis, but still, like, it's a different game. To me, the clock on a purchase with a purchase contract is what's really interesting to me about a purchase, where refi people argue, well, yeah, but we're on a clock too. Like you sell it, you lock it, and then you get it done. But for me, it was always about that purchase contract. And you just crush those all day, So that's why for me, purchase business is really, really interesting. And most importantly, look at what's happening. What I didn't do on this slide, so I'm glad you paused me, because, we're going from this 42% purchase market. Like, so a pretty healthy majority of refis this past year that everyone was really used to. This is the transition year, but look what happens by next year, right? Refis are way, way off. And we're going to do more on that in a minute. So I don't want to, I'll go into volume in a second, but I wanted to do units just to underline the point. 5 million purchases for everybody, right? So you do have to have your game pretty strong. With that said, can I go on?
Yeah. Let's rock to the next one.
So this is how many purchase units are projected for 21. And the latest data from NMLS for bank and non-bank LOs is released as of the third quarter. And this is how many LOs there are, right? So if you do very simple arithmetic, that's 9 purchases per LO for the year. And I get that that's not how the game is played, but it's a pretty interesting point to make, to just be like, you better have your act together, and you better know how you're talking to your realtors. And again, especially the refi folks that just kill on refis, it's a different set of muscles, and you do have to work them out to get them strong again when you shift back to purchase. Because to me, the purchase contract, the initial inquiry comes in, the realtor's like, hey, we're starting a search. I need you to pre-approve this person. Then the offers start coming in. You got to vet every property, make sure they're clean. Then you finally get into contract, and then you got to rock and roll on those. But you have to look at more purchases because they take longer, as you all know, to get into contract. The typical borrower shopping for 4 months. We know this, right? So you got to do a lot of them to close more than your competitors, right? So I get that there's not only, that there's the 80-20 rule. The great ones, the mortgage coaches out there, are the ones getting all the business. But nevertheless, it's just an interesting stat when you say there's only 5 million purchases in this country, purchase units that will be done in 2021.
Yeah, and here's the deal, guys. The best leaders will get the lion's share. And I want to connect the dots to just some really simple ways as a mortgage coach for you to add value. So I want to remind you guys, we have this black belt training. And one of the first things I teach someone is that you got to know how to give purchase options. And if you're adopting mortgage coach or you're a team leader, you may not want to go live on your brand new purchase lead first time you've used TC, a mortgage coach. Go back to all your TBDs or pre-approval funnel, whatever you call it, and create a total cost analysis. And it could just be as simple as down payment options. And of course, I had to bring up Hunter Markwart, a mutual buddy of Hunter is a mortgage coach, red belt. Him and his team have done over 1,000 total cost analysis. Hunter did over 240 million last year. I recently interviewed him. But guys, sometimes it's just as simple as this. Sometimes it's just as simple as purchase price options. So I just want to throw that out there because I do show a lot of pretty sophisticated ways of using Mortgage Coach. But guys, your takeaway right now should be, I need to do purchase options for my purchase funnel. And once you've done that 10 or 20 times for clients and it wasn't real time, now you bring it into your live funnel and you start doing it for clients as you go. Anything you want to add to that before you get your next insight?
Just one note. Again, it's different. It's not like sell the deal, lock it. And then yes, especially some longer lead refis, they have time to kind of stray, and they do. But on purchases, they stray all the time. And so this advice and locking them in with like, hey man, this team is on it and they are truly educating me is what matters. And then I'm gonna the next thing I was gonna show is related to that. But I will say the one just fun in the weeds thing that some of the purchase people out there will appreciate is like the one of the harder things about purchases too, unlike refis, is that it's like a different escrow team, title and escrow all the time because the realtors choose. And I still to this day, I'm like, why can't the lenders choose on purchases? And we get why, because those are usually opened by the listing agent. And then the buyer's agent who you're dealing with your customer ultimately is like sometimes sticks with them. But it makes it harder to run a big book of purchases because you're dealing with all these different escrow offices with fees and all this stuff. But at least at the outset when you're making these presentations and you're like, yes, the fees are going to move. It's all consistent all the time, even though it gets a little squirrelier later. The mortgage coach stuff is what keeps it clean for everybody.
And guys, it gives options. So you could tell the family, here's some options now, but when you're out there looking, you're going to want new options, and you're going to want the rates updated. So you're getting them connected to your online personal mortgage options that you can literally edit anytime. And so the family just gets connected. They're texting you, hey, what are rates today? Oh, I've updated your options. Oh, we're looking at a house at this price. I've updated your options. It just helps keep them connected to you. So let's get to the next insight, brother.
Yep. So I wanted to just remind everybody, I think, you guys on the ground know this better than anybody, but sorry, I'm having a little latency. There we go. This is a Fannie stat, but I think it's super interesting, and it just underlines the point that you guys all know on the ground, and the headlines don't say. And I will say, in the roles that I fulfill with the basis points work that we do across the industry, and we're quiet about the work that we do, but we're influencing more headlines and stuff you read than you might think. But with that said, that disruption narrative of like, it's all digital and da is like not borne out by stats like this, right? So this is among mortgage holders and renters, right? And let's look at that second one over, like if selecting a lender, if buying. We're still in a majority state of people prefer to deal with a human, right? And of course, the digital components matter. If you go over to completing the application, that's where you start to get into a mortgage, a majority of preferring to do that stuff digitally. But then when you get to signing, look at that overwhelming majority of human advice, right? So to me, these overwhelmingly speak to why retail loan officers on the ground are so firmly entrenched in the process that they will transcend headlines, I think, for years to come. And I'm happy to debate anyone, including a lot of the disruptors that I talk to, on that point. But you guys know this, so I'm preaching to the choir here, but I still just wanted to make a note of it anyway.
Well, I think the value here for the mortgage coach is this high touch, high tech. And when you're local and you're referral based, you can provide that high touch, that in-person experience. Now, depending on where we're at in COVID, when you're watching this, depending on what state and county you're in, maybe you're in a pure Zoom, and instead of saying in person, it's a Zoom experience, or as close to it. But you got to be that hybrid of high touch loan officer. And I'm with you. This trend is here to stay. I just think when a consumer can get value and can get communication digitally, they don't want it, they demand it, and they will go to someone else that has a really good hybrid experience.
But to be clear, like what a great loan officer using your suite is doing is that's, to me, smart human advice. Of course it's powered digitally, just like the app and the process is now, but it's still all about putting the human in front. That's what these consumer stats tell us, is that this human in that previous example, Hunter, my former colleague, him and his team are in front. That's what matters. It's not the brand.
Let me ask you something. I want to show something else on my screen.
Preaching to the choir.
Yeah, like this is a example of a purchase options where it was like 2 loan amounts, and they put a video on it. Now,
exactly.
Again, you're just, every chance you get, you're communicating in a super personalized, humanized, local way. Is that the takeaway?
Yeah, absolutely.
Video on everything that they can.
And again, like sometimes I feel like I'll say it a few times on stuff like that. Like, I know I'm preaching to the choir, but I am telling you, as somebody who's very, very involved in all the disruption that's going on out there, I still believe in this ground game. That's I guess the point I'm trying to make personally.
Love it. All right, cool.
So let me go back to, should we go to the next segment? Because I know this is a hot one for you. This is the debt consolidation stuff. So to me, if it's okay, can I share some
Yeah,
stats? Yeah. All right, cool.
And
So
I
here's,
did want to
yeah, go ahead.
frame it, guys. So one of the ways that this conversation started with Julian is we're coming to market with our new upgraded debt consolidation functions. And so I want to call the smartest people I know. Julian was my first call. Like, hey, what are the stats and facts around debt consol and the new functionality that we've built into the platform? So first of all, thank you for doing a little research on this. And guys, you want to follow what he's getting ready to share. I think it's super
Yeah,
important.
totally. This is interesting stuff. So this is here we go. So there's about 14.35 trillion in outstanding housing and non-housing debt in America right now, right? 10.22 trillion of that is mortgage debt, and 4.13 trillion of it is non-housing debt. And you can see the kind of a couple of the key categories here. So you can also see the over time since 2004. This is New York Fed data. So this is kind of to me, like, on the one hand, it's like, yes, debt is growing, but on the other hand, from where we sit, is there an opportunity for debt consolidation? The depositories especially don't like me saying stuff like this because the non-housing debt is much higher interest and it does better for them. But we know in the housing finance community that non-housing debt is way cheaper, right? So debt consolidation is a major important play, and you can see here that that there's plenty of opportunity. I will say this before I go to the next slide where we talk a little deeper about it, is that, like, pro tip, I know most of your folks know this, but for those that don't, I've had this conversation for years, but like IRS publication 936, right? That's the mortgage interest deduction publication. And you can't forget, for those that don't know, and I'm always a little surprised at how many loan officers sometimes don't know, but the non-housing debt, when you're doing debt consol, is not deductible. And Mortgage Coach does help you make sure that when you're selling, that you're not, communicating about the fact that the mortgage debt that's not deductible, you're not overselling that as a deductible expense. I've seen too many marketing campaigns over time or individual LO sales being like, let's convert your non-housing, interest to deductible debt. Not true. The IRS doesn't allow that. So that's just like a pro tip for those who aren't maybe quite in the weeds. I'll pause for 1 sec, and if you have anything on that, or I can just go to the next one, which is also really interesting.
Well, is it have to do with debt consol? Like, finish the debt consol.
Yeah. No, this is debt consol. So let's go into this. So just a couple quick more notes. So the opportunity is huge. The borrower profiles are super strong. So again, this is the latest New York Fed data on delinquencies across all the core debt categories, including housing, by the way. But notice, like, even credit card, which is a very, very common one, as we know on debt consol, credit card debt, paradoxically, delinquencies are actually lower. And we've all seen these trends as COVID has played out. People are just not going out as much. So it's surprisingly, even with the job loss and all the horrible things that have happened, the credit profiles are in pretty decent shape, which is then what we can see by generation on the right from Experian. So you've got, very qualified borrowers. And then the last note on the debt consolidation that I think is super important is that that's all the borrower stuff, but you guys on the ground know this better than most, but we're finally in a position where we have strong borrowers and we have record equity, right? And so BK is the best keeper of the equity data. And, we're still at like 6.6 trillion aggregate equity. And the way they measure it, and this is very important, there's a footnote that you can read it here, but I'll say it out loud, is that this is the equity based on going up to 80 CLTV, right? So it's a pretty strong number, in my opinion. And therefore, aren't in a situation like you were post '08 by any stretch of the imagination. After the crisis that we've been having, like this is a key opportunity, but I know that you have more to about it in terms of how it plays out on Mortgage Coach.
So a couple things. I think this equity tells me two things if I'm a mortgage professional. It tells me that there's a lot of families that have never been in a better position to move
That's
up.
right.
Real estate's looking good. They have more equity than they've had before, which means their ability to take out that equity, whether it's by selling their home or whether that's by buying a new home, it's never been better for them. Like moving up has never made more sense if you believe real estate values are going to keep going up, and most people do.
Yep.
So being able to
Although, yeah, go ahead.
yeah. So being able to do a move up analysis, and I actually just interviewed Eric Bible. It's his second full year in the mortgage business. He was an assistant for 3 years. And he did 140 million last year. So I
Wow,
mean,
good for him.
killed it. And he was, one of the strategies. I just interviewed him. It will be on our YouTube channel any day now. And he was saying how, hey, I'm doing this all the time. I'm showing a family, hey, here's your current situation. Here's a possible refi. And then, hey, here's a purchase with minimum down, and here's a purchase with maximum down. And he's using Mortgage Coach to help them visualize that and help them, look at the net worth that they could gain by doing it. So just remember that. And then, of course, for the family that's like, no, we're digging our home. We either want to fix it up, which a lot of people do, or they want to do debt consol. This is the new release for Mortgage Coach. For anybody that is a mortgage coach, this is in your platform. We call it the advice engine now. Your families can get it. And if you put in the debt consol feature, it will break it down. Like we tried to create something that was so valuable to a family, they'd be willing to pay for it. Like this is just valuable advice for a family to have a loan officer put in their mortgage information, their car, their credit card, student loans if they have them, and then do some scenarios. Short term, what's that look like? Long term, what's that look like? And then of course, net it out for the family. Like based on your strategy, how much total savings are they going to have? So guys, this is a new feature in Mortgage Coach, an upgrade to our total cost analysis, so that we now have a debt consolidation analysis that's literally the best one in fintech.
It's
I mean,
very slick. Yeah, it's I think that's the case too, because you're so deeply integrated into so many key systems, marketing, LOS, et cetera, that it does make it easy too. I mean, this is just a fun fact that you and I know, but like back in the day when I was using this like early, I liked it so much. It was early. Like I was a bleeding edge early customer, and it was like, and then we had security restrictions. So I'd like take the DU file and then like upload it just so I could create these reports. And it's because I actually came from the money management business. And so these types of reports were really important to me to be able to communicate in a way that people are like, wow. And then a stat that you shared with me that struck me was that people are sharing this stuff because like the total views of each report it's not just like the one customer is using it. Like I know that you have some crazy stats on that, but they were very impressive because this stuff's getting passed around in the families, right?
Absolutely. So really proud of the fact that 1.7 million total cost analysis were created in 2020. And then it's a link. So you could share it. The family could share this link and the family can re-click on it. So when I told you the other day that they've been viewed 5.5 million times, I know that's not loan officer views because we track
That's right.
if it's coming from the loan officer, but I don't know if it's the same borrower looking multiple times. I don't know if it's a father-in-law or a realtor or a financial planner, but I do know that 5.5 million times someone clicked on a Mortgage Coach link and got clarity and value. So we're pretty proud of that.
Well, let's just say that these are getting passed around more than LEs are getting passed around, right? So
true. For all you executives listening in, you want your loan officers delivering a shareable piece of mortgage advice that's compliant.
That's right.
got your brand on it. It's got the loan officer's brand, and it's actually giving consumers clarity and value. So thank you for that plug, bro.
Yeah, no, for sure. And then do we have time to do this last quick
Yeah,
topic? This is
yeah.
an important one. So pivot to purchase. There's 5 million purchase units that you got to go make sure that you're going to get your share of. And then the debt consolidation, you've got 4.1 trillion in non-housing consumer debt, along with record equity and strong borrower profiles. That's like a great sort of specific kind of just cash out refi opportunity. But then you have just kind of your basic refi battle for 2021. And I just want to underline this because so much of the chatter is like, oh, it's going to drop off. And like, yes, it is, but let's get real about it and just talk about it for a second. Okay. So this now is different from the one that we looked at before because this is volume, right? And so, and interestingly, for what it's worth, side note, just this morning, Inside Mortgage Finance came out with their 2020 that's totaling out at around 4 trillion. And I talked to both them and the MBA today to be like, whoa, that 3.57 versus 4 is a fairly large discrepancy, and they have different ways that they source the data. And I do tend to skew a little bit more towards MBA data, which this is, but no matter how you slice it, it was this gigantic record year. It blew away 2003, which was my first full year originating, actually. And so I kind of came into one of these types of markets, but let's look at the drop off now. So 60% refi 2020, 2.15 trillion goes down to 43% refi, 1.1 trillion. So the bad news, a trillion less in refis. The good news, there's still a trillion in refis, right? That's a ton of refis. Was going to use an expletive, but I didn't. But that's a ton of refis, you know? So, and we saw the units before as well, but this is, and if we want, I can flip back to the units, but, this is plenty for people to kind of sink their teeth into. But the thing is, and by the way, just so you know, on the purchase story, the same story holds on the volume analysis as it does on the units analysis, that you're going to a 3/4 purchase market by next year, market share wise. But let's go to this last one, just because this is another one from BK that I think is critical. The black line that says 18% means that for all refis, lenders are only retaining, 1 in 5 of those, or, 18%, right? So I wanted to end with a question, because this is like a lender conversation. This is happening. This is how technology decisions are getting made. This is like stuff that is on every executive's mind. It's on every fintech company's mind. But I wanted to kind of talk about it through the lens of the on-the-ground loan officer as well, because I think loan officers would see this stat, knowing what they know about their own book, and be like, fuck that. Like, I retain more of my people than that. And I want to know, Dave, if you think that's true, because the stats are the stats, but I do believe that most loan officers would look at this and be like, no, I'm better than that.
It is one of those things that has constantly driven me crazy. And I have always been surprised how weak retention is for everybody. And just about every time I audit just a complete baller, top producer, killing it, and we look at their past customer pull-through rate, they're losing a lot of loans, and usually it's about 50% of what it should be. I kind of always think like you should, if you've got 100 past customers, you should be doing 10 loans a year from those. If you've got 1,000, that's 100 loans. And usually, even with the best referral-based loan officers that kill it at purchase, I think it's like three to 4. So I think that this is, and by the way, it's so unnecessary. It's like the biggest waste for everybody. And I am going to make sure everybody knows a mortgage coach way to do it, but let's finish the stats. And by the way, guys, if you're watching this right now, whether you're watching this on Facebook or you're watching this on YouTube, what's your retention? What is your past customer pull-through rate and retention rate? I do want to remind people that Sales Boomerang, which I'm a big fan.
Yeah, I love Alex.
Yeah, I love Alex. I love Sales Boomerang for C-suite executives. Just in part of his sales process is he gives you a report showing you, hey, here's Here's your past customers. Here's how many loans you lost, and who they did their business with. So I would push everybody in the mortgage business that wants to make the next 5 years better than the last 5 years. Get serious about your pull-through rate. I'd make the case that that's your number one metric. Because if you have a great metric at your pull-through rate, you're gonna have a great purchase business. You're gonna
Well,
have
and this is the year, because if we just as a reminder, like, it's one half of the refi opportunity is one half in 21 as it was in 2020. Did 2 trillion and change last year. We're going to do 1 trillion and change this year. A lot of loan officers I know are sitting here saying, yeah, but that'll all change. The stats are always off. The predictions are always off. Yeah, maybe, but most signs point to this was not an inherent structural crisis. This was an exogenous crisis, right? And when the vaccines start to permeate, like, there wasn't some fundamental toxic underlying structure of the markets that caused some strain, that caused rates to go down. We're going to rebound probably pretty fast. And I believe this year, and you can have me eat my words later if these are wrong, but I believe that these are going to be pretty accurate this year, where rates are going to come up a little bit. I don't think they're going to spike, but they're going to come up to cut the refi opportunity in half. So you got to get your retention in order. And one of the big things for me is advice is a component and sharp pricing is a component. Those are the two components, right? Advice matters. I always operated in high price markets where you got sophisticated borrowers and price is everything, and they'll leave you for, an eighth all day long because they're big loans. But I think most of you guys that have the great advice and have the mortgage coach tools, you can deal with eighths, and the rest is just the engagement and keeping those. And it's going to be more important than ever this year. So that's my little soapbox on that.
Well, it was a good soapbox. So, guys, I want to remind everybody in the mortgage coach community, the fastest, most efficient way to deliver a rate and term refi. And it's got your brand, it's got your picture, and I would tell you, this interview with Amber Kovarik, she puts a video on every refi TCA, even whether she talked to him or didn't talk to him. Now, this year she was doing a lot of them, at nighttime. But here's the move, guys. Make sure that you're going beyond what every other loan officer does. You're showing, hey, here's your current loan. Here's your refi. And I don't care whether the savings is a little or a lot. Always show people the power of that savings. Like, it's good leadership. It's valuable. In this case, she showed them that they could pay off their house in 21 years. So this is a move that everybody should do. If you're new to Mortgage Coach, this is also a really easy thing. Go to all your past refis that you didn't convert and create one of these TCAs. Just like I said, when you get started with a Mortgage Coach, go to your pre-approval funnel, create purchase options, send them out as an engagement. When you get started with Mortgage Coach, if you're not already a brown belt or a black belt and we are integrated into what you do, go to all your past refi leads and create one of these. Super simple. And again, it gives the family value. And as Julian said, it's shareable. It's a shareable TCA. So it is a link. You click on it and families can make better decisions. So I'm going to put a link to the Amber Kovarik, the fast and easy way to create TCAs. She also put a little video on it that was just for you. Like, it's for the Mortgage Coach community. So bro, any more slides, or we pretty much?
No, I think, yeah, that was it. But I saved some stuff that we can talk about, some other topics as we move into next month, because there's some other interesting things to share. But I will say this: I did just look at the Inside Mortgage Finance data on the top lender, the top 50 for 2020, and the trend of the non-banks having the strongest advisors and winning a lot of this market share continues. And I think that that's important. I think banks and non-banks all have very, very relevant contributions to the marketplace. But I know the non-bank community is a big, big part of your community, and just crushing it, and very well poised to keep crushing it this year too, because that engagement's what's going to win those refis and the purchases this year.
Agreed. So Josh, thank you for your comments. So Josh, talked about how it looks like you're doing everything right. You're using Mortgage Coach, you're using text, he's using BombBomb for videos. Said we are closing about 50% on our retention.
Okay.
So Josh, I'm not gonna say you're not, but here's the number I want to know. And you probably can't calculate it. I want to know how many past clients do you have and how many past client loans did you do last month or last year? And if it's not 10% or higher for the year, 10% for the year, and last year was a big refi year. So really that number should be probably closer to 15%, because we know, and I don't know if you know this number, but a lot of secondary guys follow, it's called the constant prepayment rate, and they know what their churn is. And in average markets, it's 21%. I'll guarantee it was in the high 20s, 30s, might have even been in the 40s. Do you know what the constant prepayment rate was
Not
last
off
year?
the top of my head. No, I'll dig
So
it up though.
if anybody knows it, put it in
Yeah.
chat. Like, if this is what portfolio managers, they're like, hey, my fixed rate loans are at this prepayment rate.
Yeah.
But guys, it was high. And so don't just I think I'm at 50%. Make sure you check out Alex at Sales Boomerang, salesboomerang.com. Tell him Julian and Savage sent you. And guys, get it together on your pull through.
But I will
Julian,
give Josh a shout though before we close. Like the retention industry wide, 18%. So if he's at 50, man, killing it relative to the industry. But again, that's ground game stuff. And like I agree with you that it's like, all right, push for more. Always people running books as opposed to people running whole companies. They're the ones in control of the retention.
But I also want you to validate it. That's what I'm saying, Josh. I'm not saying you don't have it, because you might. I just want every loan officer, like, prove it to yourself. What's the measure? So guys, I'm going to be bringing Julian back more often. He committed to me that this year I'm going to get him more than twice. So if you have questions,
no, recurring. Julian,
recurring. So if you have questions that you want me to ask him, or you have insights that will help you with your agents, or you have insights that you think will help you on social media, let Julian and I know. You can either post it in comments down below. You can interact with Julian on Twitter.
Yep.
Engage. Please, guys, best way for us to say thank you to Julian, it's to follow him on social media. It's to engage on his channels. And that's how you say thank you to Julian. I'm not even going to ask you to like down below. I'm going to say, go to Julian's Twitter, follow him, like him, and engage on his communities, guys. Julian Hebron, bro. Appreciate you, brother.
As always, Dave. Boom.
All right.
I'll see you later.
Take care, everybody. Hope you got value, everybody.